all these years that we've been talking on this here podcast about the political uncertainty in China and how, like, can we buy the stocks, etc. Xi is now saying on his tour, China is a source of stability and certainty. The U.S., what the heck is going on over there?
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
On today's episode, we got a few things for you. They are all wrapped around what is the capital that's sitting right now in the U.S. markets. We're going to hit that from a few different angles. Going to start off with saying, who owns American debt? The $36 trillion people talk about all the time. Who actually owns it? Then we're going to go into the shift or potential shift away from American investments, what's happening there. Hit the standoff with China that's happening right now and what that might mean for the markets, and then wrap it up with private equity and the locked up capital we got going on.
Do we really have to talk about the standoff with China, Doogles? I mean,
yeah. Are you not familiar with China?
I'm familiar.
China? Okay, we gonna do it. We gonna do it to it. Okay, I'm gonna put this first part as a little bit of a quiz for you. Quiz is what we call quiz up here on this show. Who owns American debt is the question. Here's the first thing I'm gonna ask of you. Okay, you get yourself ready. Get your mentals all ready.
Yeah, let's go.
First question: what percent of American debt is owned by non-U.S. entities and or individuals?
I think it's about 25%.
Crushed it. That's right. About 25% of American debt is owned overseas. What are the top 3 countries that own American debt?
Gonna go Japan, China, and the UK.
My goodness gracious. Holy matrimonious Patrick Antonius, my friend. You nailed
none of this is hard. People don't know this stuff?
Okay. I want to see you like Jimmy Kimmel walking on the street. I mean, like, what's the third largest holder of...
You ever watch Jimmy Kimmel? And the problem is, I would get interviewed on Jimmy Kimmel. I get all the right answers, and they wouldn't show me on the actual television program. That's
because you're not interesting. You're not interesting, right?
Well,
you can't be knowing the answer.
What are you saying about our podcast here, Douglas? Come on.
That's true. And that is right. So we got 25% of U.S. debt owned overseas. Mm-hmm. And of that 25%, Japan, China, and the UK. Roughly, Japan owns something like 3% of U.S. debt. China is like 2 point something percent, and the UK is about that too. So the reason I bring that up is because there are 2 things that are true from that list. One is those countries are large holders of U.S. debt. Right? Between them, there's about 7%. And it's also not as large as some of like the qualitative narrative can be there.
Especially around, I mean, people act like recently with the tariff escalation and trade war, I hate that term, but people act like China and the US are the only 2 countries in the world. Like, it's just not.
Are there other countries? Name another country. You can't. You can't. You can't do it.
And one of many players. Certainly there's a dependence there on the trade side and the rare earth metals side that someone could have thought about before escalating tensions here. But that's a whole other story.
The tensions are you brought this up. The tensions are so funny to me, though. If I come to you and I'm like, I'm going to increase your prices by 3x. You're like, no, you're not. Like, you're just like, it's not going to happen. So can we have a conversation?
It's kindergartners, dude. It's totally like, my dad is stronger than your dad. Like, that's where we are. I mean, Japan, a much stronger relationship. I was just over there at least 6 months ago. No animosity towards Americans. Did you see the congressional speech or their Senate or whatever, where their trade minister talks about how this is extortion and it's not fair to negotiate with the Americans because they basically are acting like kindergartners? Like, it's a very real take.
Yeah. Oh, it's absolutely. I'm going to hit on a little bit of that too, but with regard to China in a little bit, that's a real take. It's like the largest, wealthiest person in a classroom, one day just showing up and deciding to start slapping everybody across the face. And everyone's like, well, can we just like learn algebra?
All right, keep going.
All right. I'm going to parlay that now into this piece by James McIntosh, friend of the podcast, love James McIntosh, in the Wall Street Journal. It's called, Will the Last Investor to Leave America Please Turn Out the Lights? It is a hyperbolic and dramatic headline, but I love James basically for that reason, because he comes out with the hot takes. He does not play around coming out with the hot takes.
Well, he also comes out with like the hot but incredibly well-researched and almost foolproof takes of like, nope, here's the data, deal with it.
Yeah, he's a guy that you're not gonna find him and like bring up the next question and he'll be like, oh, actually, I haven't thought about that. Like he's already raised the second, third, fourth, and fifth question, researched it, and brought you them answers.
Mm-hmm.
That's why we love James up in here in the show. Oh, he lays out in this piece 3 different things that have happened. When he looks back at the stock market over the past, let's call it month or 2, he says there are 3 key areas of the market that have happened. The third, though, which is around the shift for American investments, is one that hasn't fully happened yet. So we're gonna touch on that one in more detail, but I'll just name the first 2. So the first thing that he says has happened is trade. You don't like the term, but trade war. TRADEWAR. I'm just going to like throw that in your face because you hate it so much. Trade war. So he brings up trade. He's like, everyone's already familiar with this. We got all the tariffs, blah, blah, blah. I'll skip that one. We talked about it enough. He's like, trade is one thing that's happened. The second thing that's happened, what we just touched on, is debt. And we talked about this a little bit right now around who owns American debt. We also hit on it in prior episodes around the bond yield spike, the unexpected bond yield spike that happened. And so he's like, debt's another thing that has occurred. And then the third one, he calls it De-Americanization. And this is one, in his own words, he's like, it started to happen a little bit, but it has not really unwound yet. Will it? Question mark. But if it does, there's a ton of money that would then come out of the U.S. capital markets. That's what he says. There's one graph that he has in here that I'll talk through, and then I want to drop a couple key points that he names. In this graph, he looks at the net amount of investment between the U.S. and other countries. So if you take how much foreign assets do Americans own, and how much American assets do foreign nations own, and it has been steadily and then aggressively increasing toward more foreigners owning U.S. assets over the past 20 years. He's got a graph from 2006 to now, and it's gone from roughly, I'll call it about $1 trillion net to almost $30 trillion. So again, to say that again, foreigners own about $30 trillion more in U.S. assets than Americans own in foreign assets. Really interesting. These things are always more helpful to know in like a relative basis, like what percent of total assets, et cetera. We don't have that here, but it's just a big number. Let's just treat that as a big number. And the key point that he's making is that if you do have increased de-Americanization, that you have $30 million net that could go out of the system. And
wait. Doogles, you're saying that other countries are investing. This sounds like an imbalance. This sounds like a trade surplus and a trade deficit. We have to fix this immediately. How dare they can't be allowed to invest in our country?
Hold on, are they taking advantage of us again?
I think they're taking advantage of us. Of course, they've invested more. The U.S. stock market has been an incredible performer basically since 2010, as you compare it to the rest of the world. So that becomes a self-fulfilling prophecy in terms of like, oh, hey, around 2015, 2016, it's like, I live in the UK, I live in Japan, and my stock market's not doing anything. I got all this capital. Oh man, I want some NVIDIA and some Tesla, right? Like, so more money flows over here, which artificially inflates prices and makes the US stock market one of the most expensive in the world, which it's now been for pretty much consistently for the past 4 years. The U.S. stock market's been one of the most expensive stock markets in the world because all the capital is flowing here.
There are 3 things I'll name here. One reason, outperformance. You want to buy that Tesla? You want NVIDIA? You want the king? Yeah, come to the U.S. Second reason is because the U.S. has an exceptionalism complex that the
Yes.
world has upon us, right? We are viewed as kind of a safe haven, even in our stocks. And third, and this is what James McIntosh doesn't hit on, but we touched on it briefly before. And this relates to the trade deficit. If you are running a trade deficit, reserve currency, which we did hit on, dollars are out in the world. One of the things that you open up is the possibility for people to have more investment in your nation. Like those two things are related. The more that we are buying goods from other countries, the more likely they are going to be to invest in our country. So those two things are related. I don't think it's intuitive for everyone. So it's important. So those are three things that have led to this. Now, what is de-Americanization? It's when people decide, let's go back through those things. People decide, one, actually, it's outperformed too much. There are other places that can get a better return.
No one's deciding that. I mean, that's a sophisticated thought. What's happening is, I lost 10% last month. And there's more uncertainty in the U.S. than there ever was be. And I might not trust the rule of law. And I'm concerned about their immigration policies. Sorry, it's simpler. I know what you're trying to say, but it's simpler than that. It's just I don't really trust this anymore is what's happening.
I get that. There's whether for whatever reason, I'm going to put my money elsewhere to get a better return. Whether that's because I'm freaking out because it's gone down 10% or whatever it is. There is also, I think this is different. The second thing that you just said is right, but I think it's a different point. The uncertainty that's been raised in our country, going to the safe haven point, has made it such that maybe the U.S. isn't all that different. I was in Istanbul for a night, heading back from Paris. Walking around Istanbul, Turkey, there are people got AK-47s everywhere. To get into any building, you got to put your stuff through. It has escalated recently because their president put his rival in prison right before the elections were going to happen. People started protesting. I think shocked. People are saying, people are not necessarily saying the U.S. is there, but if you start to extrapolate the amount of power that a central person can have anywhere, this isn't even Trump specific, it's just in general, you go, is the U.S. actually that different than other countries? And once you even raise the question, whether or not that the answer is true or not, when you raise the question, it goes from people automatically being like, yes, the U.S. is definitively safe, to it's no longer definitively safe. That just means people are looking elsewhere. Whether or not they move their money, you just start to look elsewhere. Then there's this fact of growth. So when you think about growth, what fuels growth in an economy, macro-wise?
Spending.
Yeah. And what fuels spending? Lower interest rates. And so the U.S. is putting itself in a position where we're like, okay, the reasons that the Federal Reserve, on its own, with no other intervention, would decide to lower interest rates is because we feel like inflation's under control or there's something with unemployment. And with the tariff uncertainty, Powell's likely in a place where he's like, it's really hard for me to say that inflation's under control when we are aggressively trying to increase prices.
Come on now. He effectively said that. He said that this week. And him and Trump had a little yelling match at each other. There's no doubt about that. He's in an impossible situation, but a Skippy and Doogles show salute to our man for standing up and saying this is a central body that will not be controlled. Because you know how catastrophic it is, that trust we just talked about? You know how catastrophic that would be if the central bank is actually not a neutral party that is not associated with political parties and politics and the presidential office?
That's scary on its own. What becomes even scarier is the folks that obviously don't understand economics then being in control of what's happening there. The thing here's the thing with Powell. So let's go back a few years. We talked about this back in late 21, 22, something like that. We were discussing the own goal that Powell basically had when he was talking about transitory inflation. Inflation's transitory. It's transitory.
Yeah, this is 21.
21 took too long to act, right? So picture someone climbing up a mountain because it's just a hard job. And then you start slipping because your own accord, right? You start slipping and Powell's like, okay, whew. All right, now I have like a 5% chance for a soft landing.
Mm-hmm.
Maybe. That might even be high. So he's climbing up this mountain, and finally he goes, hold on, I don't know if it's going to happen, but I can see the top. Like, it's possible that I get there.
I think I made it. Yep.
And then his arm comes up over, his head pops up, and someone punches him in the face. That is what just occurred right now. And so now he's like, okay, now I've done fallen back down. It's a really, really hard situation, coming out of another hard situation. And he has not done the job flawlessly. No one does their job flawlessly. And I think he messed up a few years ago, but has been trying to guide with data independently for a hot minute now.
If he messed up a few years ago, like I said, or like you said, it feels like he negotiated a soft landing against really long odds. So I'd give props to that, despite me being critical of him 3 years ago. His mess up 3 years ago was not raising rates fast enough and maybe not raising rates high enough, right? And now the political pressure is on the exact opposite of that. You know how humans work when you make the last mistake and it's fresh in your mind?
Yeah.
And then someone wants you to do the exact opposite of that. If he's going to err right now, he wants to err on the side of anything but a rate cut and potentially a rate increase to tame inflation, which we all know is coming, unless global trade just stops, in which case inflation is still coming. There's just less choice. So we either get inflation with choice because there's crazy tariffs on things, or we get inflation with no choice, scarcity, and we have bare shelves. Like, he's in a terrible situation, and to expect him to cut rates or imply that rates are too high at the moment is, I don't have words. I mean, I cannot come up with an argument that says rates are too high at the moment. And the only people I see coming up with that, the only people that come up with that are people whose job and wealth is dependent on low rates. Those are the only people I've seen argue for that. And we're going to talk about that with private equity. You guys need to look in the mirror. You people that need low rates. You messed up. It's your fault.
Absolutely. So, as a reminder, inflation, too much money chasing too few goods. And so, therefore, what you're saying, because there could be a double whammy here. What you're saying here is there's one world where you say people are going to spend too much and buy too much stuff. So therefore inflation. The other world where you say supply will be so constrained that you still have too much money going after scarcity, as you named it. And there's also the case where those two things come together. Where people, which is what happened, right? We had people spending too much and supply chains were wrecked in 2020. And so what happened last time was those two things came together. Can we shift to your least favorite topic of this podcast?
Guess so. Yeah, I guess so.
Standoff with China. Standoff with China. We getting at it. So the reason I want to talk about this, I don't want to talk about the 120, 130, like the auctioneer type situation. That's not what we're here to talk about. What I want to discuss is what I've read around what perfectly makes sense to me, what China's doing right now. We talked about before how if I, Doogles, was President Xi, that I'd be like, okay, I'm just going to let America ruin itself, basically. Like, I'm down to take the pain for my country.
And to be clear, he's on the record saying that like 4 months ago, right? He
there
said,
you go.
I'm going to just sit back and I'm not going to poke the bear. I'm not going to do anything. I'm just going to sit back and let Trump cook.
So let's give a little context here. If you look at the U.S. and China and our relationship with regard to exports, imports, one thing that you've probably heard, I've heard this said, which is not true in the way that it's been said, is that the U.S. has $1 trillion trade deficit with China. Not true. The U.S. trade deficit with China is something like $200 billion, $300 billion. It's still large, but it's like $200 billion, $300 billion. China has $1 trillion trade surplus with the rest of the world. That is not the U.S. But to what you said earlier, if the U.S. and China are the only two countries, then
no. But of course they do. In our previous example, where you're talking about Target or the local breakfast burrito shop or whatever, they're like the world's grocery store, right? That's where a ton of stuff gets manufactured, and it gets manufactured there in a way that's cost effective for the rest of the world, who happens to be significantly wealthier on a per capita basis, and everybody wins.
And you like shone a whole light upon me right now. This is something that I hadn't realized before. So I previously thought that when Trump has said that we have $1 trillion trade deficit with China, that he was lying. But now it's untrue. The statement is untrue. But given what you said earlier around the US and China being the only two countries, I think he believes that that is true. And so therefore, if China has $1 trillion trade surplus, they have to have it with the US.
It has
I think
to be. Who else could buy from China? The rest of the world doesn't even exist.
I just think he believes it. Well, let me shine a little knowledge upon you. So here's the deal. If you look at the share of Chinese exports, by far the US is number one, but it's 14% of Chinese exports. So it's large. But next you've got Vietnam, which is like 5%. So we are 3x the next country, but it's still only 14, 15% of Chinese exports. So big, but not 100%. So let's just lay that out. The reason I bring that up is because things that Xi is doing right now is, as we would expect, is he's doing like a little tour. He's going around strutting his stuff and talking the U.S. down, as he should. This is the line that really got me. All these years that we've been talking on this here podcast about the political uncertainty in China and how, like, can we buy the stocks, etc. Xi is now saying on his tour, China is a source of stability and certainty. The U.S., what the heck is going on over there? And people are seeing that. That is quite a flip.
Yeah, I mean, again, to go personal here, Doogles owned a really nice education company in China. And one day, the Chinese government decided that company could no longer make money, and the price went down 90-ish%. This is, you rewind to 5 years ago, this is the world, right? The world would say, can you imagine how unbusiness friendly China must be? How chaotic it is to have a dictator? Everything else. You fast forward to today, and we're in a world where it's conceivable that the Chinese president, who does stuff like that all the time, can go shake hands in other nations and say, man, look how safe and predictable we are compared to the United States government. What is happening right now?
Yeah. And then the other thing that's occurring in the country of China, because it's 15%, which is not 100%, but it's still 15%, which is material, is Chinese, according to this piece that I read in the AP. This piece that I read in Reuters. Chinese suppliers to Americans now see the U.S. market as frozen. European sales are increasing, and their U.S. sales are decreasing because, well,
of course,
it's expensive. People
because math.
Stop buying.
Yeah.
Because math. And on his little tour, he goes to Vietnam, right, their second largest partner, and he's like, we should set up our own thing. You know, me and you, let's do this. And Trump responds with, not fair. I don't know what else to do there. We're going back to kindergarten.
No comment. I mean,
that's it.
What? People are acting based on math. This is not there's not many feelings involved here.
Some people are acting based on math.
Sorry, the rest of the world is acting based on math.
Exactly. Speaking of math, shall we transition to our last topic? Private equity. Why don't you kick this one off?
Okay. I just need to take a deep breath here because you managed to push some buttons in the last few topics. I know that was intentional. All right. Wall Street Journal came out with a piece on Thursday called Private Equity World Engulfed by Perfect Storm. Okay. The most interesting fact in this piece is simply that the private equity crowd, and we might have to give a high-level background here, but the private equity crowd, which has bought companies for years. So let's talk about like the last 20 years, right? Private equity had a successful model where they were typically buying smaller businesses with leverage. In a lot of cases, rolling those up. And so the classic example is, we'll buy a bunch of HVAC shops that are independently owned in different parts of your state. We'll bring them all together. We might change the branding, we might not, but we'll streamline all the back ends. We'll do everything else. And then, maybe we buy these things 3 at a time, but we can turn around and sell them with this, 200 HVAC shops together across multiple states. There's economies of scale that happens. Typically, you can sell for a higher multiple when you combine a bunch of these things, streamline the back-end operations. And the track record then looks pretty great because you did that all with leverage and you made really nice returns. Maybe you bought them at like 2 or 3 times earnings. Maybe you sold them at 15 or 20 or 30 times earnings.
Yep.
What happens here is you build a really nice track record, and then you walk into the Yale endowment and your government pension in California and everywhere else, and you say, look what we can do in private equity. Like, why are you invested in public stocks? The path forward is this. Well, that's happened for 20, 25 years. The market's pretty dang saturated. Everyone was running the same game, which is why you've seen some of the backlash. And now it comes time to sell the next round of investments, the next round of roll-ups.
Yep.
And no one's really buying them. So the first graph in this piece is from Bain & Company, and it shows the firms that are sitting. It basically says there's a record number of companies that private equity firms are waiting to sell. And again, doing these graphs on the podcast is sometimes hard, but in 2015, this number is about 7,000 total companies. And today, it's almost, thank you, 2005.
Right? Is that right?
Yeah, 2005, 7,000 companies. Today, 2025, it's basically 30,000 companies. Cut to the chase here. Like, how do you turn that return into the theoretical return into cold, hard cash? You have to actually sell the thing.
Yeah, that's how you do it.
If you can't sell the thing, it's tough. So the majority of large private equity publicly traded companies are down 20% year to date. And it could get significantly worse because if rates stay where they are, or if rates go up, that it gets even harder to sell these things because whoever you unload this garbage to, I'm calling it garbage, that's just my personal, is probably going to buy the thing with leverage. Like, it's just leverage on top of leverage on top of leverage. And that looks fabulous until the clock stops.
This is the reason why I said that all the topics that we covered today are related.
Mm-hmm.
Because if you go back, let's go back to the top. We talked about debt, ownership of debt. You're talking about leverage there. We talked about the de-Americanization, capital potentially flowing out of the U.S. China is related to that in obvious ways. And then here, what you were telling me, you, Skippy, to me, Doogles, is that what these companies need are deals. They need people to take their cash and buy their companies. And what we talked about is how people are trying to take their cash and look elsewhere. Those two things are not friends. Those two things don't like each other. And so, if you take the amount of money that is wrapped up in two amounts of monies, one amount of monies is the amounts of monies that is wrapped up in private equity right now that needs to find homes. The other amounts of monies is the amounts of monies that foreign organizations currently have in the U.S. If those monies don't become liquidity for the market, that is the great unwind that at least partially James McIntosh was saying is possible.
Well, okay, let me try and say that because I'm a little lost in your phrasing. So let's just paint a worst case. The $30 trillion of foreign investment that's currently mostly in U.S. assets, stocks and bonds, pulls back significantly. And let's say over the next, 12 months, that gets cut in half. That means $15 trillion runs away and most likely runs to foreign investments, which would be good for me because I own a bunch of that, but whatever. And then on top of that, let's say rates remain where they are and there's not really many buyers for this leverage stuff. There could be forced selling that takes place. Again, I think people sometimes underestimate how commingled everything is. So $15 trillion worth of selling might lead to a publicly traded asset value of something that's being used as collateral to go down significantly in value. That might trigger a loan that has to be paid back. And it might happen at scale thousands of times across the environment to everyone that holds a significant amount of leverage. Private equity is the easy one to pick on there, but there's tons of other things that could happen in that way. And then it triggers pretty quickly and things unwind pretty dang quickly.
Tell me if this analogy doesn't fit. But I think about it as maybe a way for folks to think about this is if you think about a household, like an everyday household. And if you say the assets that I have are separated into my home, stocks, and cash. And let's say that 75% of my assets are in my home. And the expectation of the economy is for me to go out and spend. And they're like, oh, I'm just going to use simple numbers. Doogles has $100,000 in total assets that he can spend in the economy. That is a lot. Of that $100,000, $75,000 of it is in a home. Now let's imagine that I can't get cash out of that home because the housing market is dried up, refinancing doesn't make sense, whatever. So now actually we go from the $100,000 that people might see that I could spend to something more like $25,000. The analogy to the private equity market is private equity firms have a lot of assets. But if you go back to the beginning of what you were talking about in 2005, 90% of those assets were cash they could go and spend. And so they did. They hit the markets, started buying. Now, 35% of their assets are in cash. So that's all that they have to go out and spend unless they can sell these businesses. And it's becoming less and less likely that they can sell the businesses.
Let's take the analogy even further. This might be unfair to our friends in private equity, but let's just run with it. So they did a roll up in HVAC. They streamlined the back end. They did it with 90% leverage. Let's say they did it with 80% leverage. Everything's great. They're going to sell for a better multiple. Let's even say they've increased profit margins from something like, I don't know, 11% to 20%. That roll up is worth so much money. There are so many bidders lining up to pay for 20% margins, 400 operators. It's great. If all of their air conditioners and furnaces are imported from, I don't know, maybe China, maybe Vietnam, maybe Mexico.
Not the U.S.
The business just got a little tougher. Like, you run the numbers. Maybe you wait 6 months. Maybe that business that's been consistently doing 20% margins. Oh, and not to mention your U.S. consumer theoretically gets pinched on the same side.
That's right.
Job losses, everything else. So maybe no one repairs their AC anymore. It's very reasonable to say this business that I thought I could sell, I thought I had a 3-year track record at 20% operating margin. All of a sudden we're losing money hand over fist. The marked value of that 400 conglomerate, 400 unit HVAC thing might have gone from, I'm just making numbers, the tens of millions, hundreds of millions to nothing. Like, who wants to pay for a business that's losing money?
Yeah. And it's not necessarily saying that the value is $0, but that no one's going to buy it. So therefore,
I mean, the value at that point in time, there's lots of downtown office space in St. Louis and Detroit and 1,000 other places that are these beautiful buildings, but the occupancy is 0, and the bids they get are like next to nothing because the maintenance costs to maintain the place to actually build something could be millions, tens of millions of dollars a year. So I'm just saying that the point in time asset value can be reduced rapidly, like orders of magnitude, very quickly, if the market plays out like we think it might play out.
That's right. I think we can wrap it there.
All right.
Remember, rate and review the podcast. Follow us. We got Substack. We got Instagram. We got X.
Yeah, check out premium subscriptions, skippydoogles.supercast.com. That really helps support the show. And listener mail. Don't forget that, Doogles. skippydoogles@gmail.com.
That's right.
We'll talk to you next week.
Bye, everybody.